Welcome to The Deep Dive, your essential shortcut to being well-informed. Today, we're diving into Chewy Inc., that's CHWYY, specifically their fiscal Q2 2025 results. We've gone through the earnings call, looked at the analyst takes, all that, to really pull out what matters, what's driving this pet retail giant.
Yeah, it was quite a quarter. Because, you look at the top line numbers, and they were strong, really strong. The kind you'd expect to maybe boost the stock significantly. But then management also talked a lot about strategy, about reinvestment.
Right.
And that choice, focusing on growth down the line instead of maybe maximizing profit right now, that definitely caused a stir, a bit of a market shakeup, actually. So we'll unpack that tension between the performance and the strategy they laid out.
Okay, let's jump right into the numbers then, because they do tell a pretty compelling story just on their own. Chewy reported Q2 net sales of $3.104 billion. That's up an impressive 8.6% year over year. And that actually beat their own guidance. What really stood out to me, though, was auto ship. It's just dominant, those subscription sales. Grew almost 15%. And they now make up, get this, a record 83% of total sales.
83%. It's huge. And yeah, the good news wasn't just on the top line. Profitability looked solid, too. Gross margin expanded 90 basis points year over year, hit 30.4%.
Pretty healthy.
Very healthy. And adjusted EBITDA margin also climbed up 80 basis points to 5.9%, which came out to $183.3 million. So operationally, looking good. Metrics are strong. They even raised the full year sales outlook.
Yeah.
But despite all that positive news, the investor reaction was, well, cautious, a bit muted.
Exactly. That's the disconnect, right? Non-GAAP adjusted diluted EPS was up 37.5% to $0.33. I mean, that's robust growth.
Yeah.
Yet the market's first reaction seemed to pour some cold water on it. Led to a pretty noticeable stock reevaluation on the day of the call. It felt strange. Strong numbers, lukewarm reception.
It absolutely did. And you really hit the nail on the head. That disconnect, that market caution, it mostly came down to what management said about reinvestment. They were very explicit. So they're making a deliberate choice here, focusing on long-term growth, even if it means, not all the profit flows straight to the bottom line in the short term. And that seemed to be the sticking point for a lot of investors.
Okay, so let's dig a bit deeper then. Beyond those headline numbers, what's actually powering Chewy's engine? What are the mechanics behind this performance?
Well, the core story is still that subscription-led retail flywheel. It's just incredibly effective for them. Active customers grew to 20.9 million. That's up 4.5% year over year. But maybe even more important is the net sales per active customer, NSPAC they call it. That saw a really healthy 4.6% increase, hitting $591.
So not just getting new customers, but getting more value from the ones they have.
Exactly. Both acquisition and deepening that wallet share, making each customer more valuable over time.
And that auto ship number, again, 83% of sales, growing 15%. That's just massive. It sounds like a pet parent's ideal setup, right? Never forget the dog food. But what does that kind of concentration, that stickiness, tell us about their customer loyalty, about their competitive advantage?
Well, it points to a very, very strong and resilient customer base. Auto ship isn't just, convenient. It changes the whole relationship. Creates predictable revenue for Chewy, obviously. But for the customer, it becomes this sticky, almost automatic buying behavior.
Right.
As for the gross margin expansion we talked about, those 90 basis points, that was mostly driven by two things. One, their sponsored ads business is growing fast. That's basically Chewy letting other brands advertise on their platform, high margin stuff. And two, they saw a favorable mix shift into premium categories, like health products, specialty consumables. Those just naturally have better margins.
Okay.
Management did sort of suggest Q2 might be the peak for gross margin this year, but they still expect healthy expansion annually overall, just maybe not quite that fast every quarter. Got it. And we also saw strong free cash flow, right? About $106 million this quarter. Always good to see. And speaking of cash, they bought back shares. About $125 million worth. That's a pretty significant return to shareholders.
Yeah.
Signals confidence, doesn't it?
Absolutely. It shows management believes in the company's value, even while they're making these big strategic investments. It's a strong signal. Now, on the cost side, there was talk about SG&A deleveraging.
Okay, let's break that down. SG&A deleverage means costs grew faster than sales.
Exactly. Selling, general, and admin expenses outpaced revenue growth in Q2. That put a bit of pressure on margins. They said it was mainly due to ramping up the new Houston fulfillment center and also winding down shifts at the older Dallas facility. Plus, higher costs for handling inbound inventory, especially for art goods.
Right. Temporary growing pains, maybe?
That's how management framed it. Largely temporary increases. They still project modest SG&A leverage for the full fiscal year, meaning they expect those costs to grow slower than sales over the full 12 months. Okay, so the core business is chugging along, generating cash, expanding margins. But Chewy's clearly not just sitting back. What are these big strategic initiatives they're pushing? What are the bets they're placing for the future?
Yeah, they're definitely making some big moves. Chewy Plus is probably the most talked about. That's their paid membership program.
Oh,
And it seems to be getting real traction. They said in July, roughly 3% of total monthly sales came just from Chewy Plus members.
3% already. That's pretty quick uptake.
It is. And what's really crucial, they emphasize the incrementality. These members, they spend more, they have higher NSPAC, buy more often, adopt AutoShip faster, use the app more. You get the picture. Better customers across the board compared to non-members.
Interesting.
The goal is for Chewy Plus to contribute a mid-single-digit percentage of net sales by the end of this fiscal year. And they expect it to actually generate positive gross profit dollars in fiscal 2025. So it's becoming a real pillar. It's kind of their answer to, Prime or Costco memberships.
Makes sense. And then there's the new private brand, Get Real Fresh Dog Food. That feels like a smart move into a hot market. I know my dog would probably sign himself up for a fresh food subscription if he could figure out the app. What's the strategy there, tapping into that premium segment?
Precisely. Get Real puts Chewy squarely in that booming fresh and frozen pet food space. It's projected to grow massively from maybe $3-4 billion now to potentially $8-12 billion in the next few years.
Wow.
And strategically, it's an AutoShip-only subscription business, designed specifically for high gross profit per unit. They said the initial reception is strong. About 70% were existing Chewy customers trying it. 30% were new. And they're seeing potentially very high annual spend. Over $800 for just the food toppers, and maybe $2,500 for customers using it as the full meal.
That's significant spend.
It is. And they've apparently already built out the production capacity needed through 2028 using their existing CapEx plans. So they're thinking long-term infrastructure included.
Okay, and they also talked about Chewy Vet Care, the CVC network. That feels like it rounds out their whole offering, moving beyond just selling stuff.
Absolutely. It's a critical piece of their health ecosystem strategy. And they said CVC is actually outperforming their own expectations. It's driving the highest and fastest NSPAC growth curves they see, meaning those vet care customers become incredibly valuable very quickly.
So they're leaning into that.
Definitely. They're on track to open another 8 to 10 new practices this fiscal year. That'll bring the total up to nearly 20 clinics by year end. It's all about integrating those health services right into the Chewy experience.
All right, let's circle back to the guidance, because this was really the crux of the market reaction, right? They raised the full-year net sales outlook to $12.6 billion. Great news. But then they kept the adjusted EBITDA margin guidance the same at 5.4% to 5.7%. So more sales, but same profit margin percentage. What does that really signal?
Yeah, this is where that growth over profit idea really took center stage and created that market tension we talked about. Management was explicit. They said, look, we're making a deliberate choice here. We're taking the extra profit potential from those higher sales, and we're reinvesting it straight back into growth.
Okay.
So more money for Chewy plus Pute, more for expanding private brands like Get Real, and also using it for some selective pricing strategies, all aimed at grabbing more market share faster.
So building a bigger company now, even if it means slightly less profit hitting the bottom line today.
That's the trade-off they're signaling. They're prioritizing building a larger, more dominant business for the long run. So while keeping the full-year margin guidance steady isn't inherently bad, the market read it as, okay, short-term earnings might not get the boost we expected from the sales beat. They're choosing to invest that upside instead of delivering it as immediate profit. And just for Q3 specifics, they guided for net sales between $3.07 and $3.10 billion, and adjusted diluted EPS between $0.28 and $0.33.
So putting it all together for investors, the market reacted strongly. Stock dropped despite the sales beat. It really felt like the message received was, show me the money now.
You basically nailed it. The feeling on the street could probably be called constructively cautious. It's that classic tension, isn't it? Value versus growth playing out right there. Analysts are asking, okay, are these investments smart, long-term plays that will eventually pay off big, or are they just masking a lack of immediate operating leverage, which the market tends to punish?
Right, the prove it phase.
Exactly. So you saw some analysts like Seaport saying the sell-off was overdone, upgrading to buy, But others trimmed their price targets, raising concerns about that margin path. That growth over profit message, especially keeping the EBITDA margin guide flat despite higher sales, that was the real flashpoint. Investors wanted more of those extra sales dollars dropping to the bottom line today.
And what about the bigger picture? The pet industry itself, the economy. What environment is Chewy navigating right now?
Well, the pet industry is still normalizing after that huge pandemic surge. It's growing, but more like low to mid-single digits now. Pet ownership, household formations looking pretty flat to maybe slightly up this year. But here's the key thing. Chewy believes it's definitely gaining market share. They're growing around 7-8% on a rolling year basis, which is significantly faster than the overall industry.
So they're taking a bigger piece of the pie.
That's the claim. And they're making proactive moves too, like bringing more hard goods inventory onshore ahead of potential tariffs next year and selectively adjusting prices, trying to balance protecting margins where possible while still being aggressive enough to gain share. It's a dynamic balancing act.
Okay, so in that dynamic market, how does Chewy stand out? What are their core competitive advantages against, the big box stores or Amazon or even smaller direct-to-consumer brands?
They talk about their differentiated value proposition, which is kind of corporate speak, but the idea is combining the scale and efficiency of e-commerce with the personalized touch and community feel of like your local neighborhood pet store.
A layer cake of advantages, I think they called it.
Yeah, something like that. You've got the comprehensive health ecosystem, the pharmacy, the compounding pharmacy, which has great margins, and the vet care clinics. That's one layer. And the super sticky auto ship model, that's another big one. Add the Chewy Plus membership program, which they explicitly compare to Prime or Costco, plus ongoing innovation with private brands like Get Real. And underneath it all, they heavily leverage data and tech. They expect half their volume to be automated by Q2 next year. All driven, they say, by a really strong focus on the customer. It's trying to be more than just a retailer.
Okay, makes sense. All right, let's shift gears. It's time for our This Is Not Financial Advice segment. This is where we brainstorm an outrageous but maybe plausible trade idea based on everything we've just discussed. And seriously, remember, this is strictly for entertainment, for conceptual thinking. Always do your own homework before making any investment decisions.
Okay, so given Chewy's Q2, the strong performance, but that, let's call it a knee-jerk market reaction to the guidance, our trade idea is a conviction long on Chewy, ticker CHWY, initiated on that post-earnings dip. The core thesis is that the market is over-discounting the near-term profit picture and underappreciating the long-term strategic value they're building.
Okay.
Management couldn't have been clearer. They're choosing to invest in Chewy Plus D, in Get Real, in smart pricing to accelerate market share gains. We're looking at a leadership team that's playing the long game here. They're aiming for incremental margin expansion over several years, but on a much, much larger revenue base down the road.
So the outrageous part is betting against that immediate market reaction, betting that the street got it wrong in the short term, and anticipating a re-rating, a stock price increase. Once these investments start showing clear results, those cohort returns you mentioned, you're basically buying into management's vision. Sacrifice a little EPS today for a bigger, more profitable Chewy tomorrow. What's the big risk if that doesn't pan out?
Well, the biggest risk is always execution, right? And investor patience. If these big bets, Chewy plus Cordy, Get Real, don't show clear, measurable positive results in customer spending, loyalty, retention within the next, say, few quarters, or if the economy really takes a turn for the worse, the market could stay skeptical for a while. But we see solid potential catalysts, continued strong growth in Chewy Plus memberships, the national rollout of Get Real starting to really contribute revenue, especially with that high expected spend per customer, and just continued strong performance from Chewy Vet Care. We think these things will accelerate that NSPAC growth, create an even stickier customer base, and eventually the market should reward that. We'd put a hypothetical target price of maybe $47 within the next 12 months. That lines up with some of the more bullish analysts who thought the sell-off was indeed overdone.
$47. Okay, an interesting target to watch. And that wraps up our deep dive on Chewy's Q2 2025 earnings call. Definitely a fascinating quarter. You had the strong results, but then this strategic choice that really got the market thinking and reacting. It really does highlight that tension, doesn't it, between what investors want now versus the long-term growth plans companies often need to make.
Absolutely. Chewy is clearly investing heavily in its future. They believe these programs, Chewy Plus Co's Get Real Vet Care, will solidify their market lead and drive better profitability down the road. And, it really speaks to how central pets have become in people's lives. People are willing to spend making it a pretty resilient sector overall.
So here's a key question for you listening right now to think about. What specific signs, what visible cohort returns, as the analysts say, will you be looking for in Chewy's next few reports? What data points would convince you that this reinvestment strategy, this gamble, is actually paying off?
Yeah, that's the critical follow-up. Keep an eye on the Chewy Plus member growth and, importantly, how engaged those members are. Track the average spending for those Get Real customers. Is it meeting those high expectations? And watch the overall auto ship performance. Is it staying robust? Those will be the real clues, the tangible evidence, showing whether this growth over profit approach is building a stronger, more valuable Chewy for the future.
Great points to track. Okay, that is all for today. Thanks so much for joining us on the Deep Dive. Don't forget to subscribe so you don't miss our next breakdown. This has been your essential shortcut to being well informed. We'll catch you next time.